Ray McDonald here with iCan Financial. Welcome to our weekly call we have every single week of 11 a.m. Central Standard Time, 12 noon Eastern. This is a call we do every single Wednesday, so make sure that you're on this call / webinar. Today we're actually doing a webinar today. So like again, I always say it's important for you guys to be on these calls because of information that's coming down the pipe. You want to be informed. You want to be in the know. You want to know what's happening. You want to. These calls are again. You just don't know what's going to be on these calls once you get on here. And again, they're very, very important. They're informative, and just for us, all of us to kind of be to take care of our business and grow our business. And the way I look at these calls, and I think the way that you need to look at these calls too, is that this is a work call. This is a work conference call, webinar. We're all licensed agents. We're all independent agents out there working independently. And, we have to kind of, look at this as, look, I'm an independent agent, and this is my work. This is my business. And this is a business call that is scheduled every week. Just like if you work for any corporate America, they have these staff meetings, they have meetings, they have the mandatory meetings, if you will, that you got to make sure you're plugged into if you work for corporate America. It's just no different for you, the independent agent. You need to be plugged in to what's happening with iCan Financial. For iCan Financial, we're here feeding you the information, from the carriers, feeding information from the sales systems that will help you grow your business. And that's the bottom line. We're helping you grow your business. We're helping you increase your bottom line. So that's why these calls are so important to stay plugged into, so you know what is going on within your business, so you can grow your business, so you can take care of you and your family and financially, especially during these times that we're in right now. A lot of people are being creative by how they're doing things. And, again, this is no time to sit on the couch and say, woe is me, or this is happening, this is happening. This is time for you to take full advantage of what's going on. Life insurance sales right now is literally on the rise, believe it or not. Most insurance products are on the rise right now during this time. So that's an amazing news for us to go out there and take advantage of that opportunity and so forth. But I don't want to take too much time today, but we have a very special guest today, backed by popular demand. You guys saw in the email that went out after this gentleman was last on here kind of talking about the banking system and using the insurance products to really do that. A lot of people say, man, number one, who is that guy? I want to learn more about that. I want to know what's going on. Guys, this is the biggest thing coming out right now in the insurance world, and people are understanding this more and more. And the time is perfect for this. People are wanting to get out of debt. Everybody has debt. Everybody has. I don't care how much money you have. Some people say, well, those guys has all this money. I guarantee that the guy that has all that money, all he has is high-end debt. Everybody has debt. Everybody who has debt know other people that has debt. So debt is everywhere. So learning how to get out of debt, learning how to really use your insurance policy. But see, most people think about insurance policies like, think about it, well, it's only good when I die. When I die, my family's taken care of. Yeah, that's the old-fashioned insurance policy. We're talking about having insurance policies now that you can utilize now while you're still alive to maximize the cash, maximize your retirement, maximize your life. So now it is truly life insurance. This is not life insurance for your life after you're dead. This is life insurance now for your life right now, your current life right now. This is life insurance that's going to really save you in so many different ways. And this is so important. What Jason and I kind of share about this and just understand it, to share this message to other people. Trust me, right now the market is prime for this. And so I don't want to take too much time away. Jake's been working with iCan for quite a while. We have a great relationship with him. He's part of the family here at iCan Financial. He just really kind of takes the industry by storm. He's has a huge following everywhere he goes, and he's you'll see him everywhere. So Without any further ado, Mr. Jake Taylor, are you there, sir?
I am here. Can you hear me?
Yes, sir. A little choppy, but I can hear you. There you are.
Okay. Am I still choppy?
Yeah, a little bit choppy there, buddy.
Okay, hold on. Let me.
It sounds clear to me.
Okay, that's just your Metro PCS.
Let's see.
Ray, you're doing too well. You gotta upgrade, brother. You gotta get off the flip phone. You gotta get off the flip phone. Okay, so you all can hear me. Can you see me clear, Jay?
I can. Awesome. Yes,
Okay,
sir.
listen, y'all. I was about to say stupid excited, but I'm just like I'm extremely excited about sharing with you all these principles that we're teaching you how to bank through insurance policies. And one of the biggest things that I love about teaching you how to bank through insurance policies is that this is not anything that's new. This is something that have been going on for years and years and years, almost hundreds of years. And the concept of how we contort it has been done for decades, and exactly how we build these policies, because it makes us start to think about the best places to put our money. So before you as the insurance agent, and you as the specialist, you as the broker, you as the practitioner, before you can go out there and effectively and efficiently sell and offer these product solutions for clients, you have to be sold out on it too, right? You got to know deep down inside you're putting your client in the very best thing that's earthly, humanly possible. And that's what we're going to kind of discuss today. We're going to kind of go over that. We're going to go over what the banks do. We're going to go over how you can compare that when you're talking to your clients. We're going to go over why putting your money inside of an insurance reserve is the very best thing for you to do. We're going to go over the guarantees that you have, apples to apples comparison. We're going to talk about a lot of things that's going to give you the confidence to be able to offer these products and solutions to people. And then I'm going to give you a little historical context to show you that why you don't know about using insurance in this manner. And so without further ado, we're just going to let's get it on. I'm going to show you guys. We're going to get it on right here. So let me do this here, and I'm going to unshare my screen like this, and then I'm going to pull this up right here. So can you guys see my screen? I can't see y'all's chat, so Jay, you're going to have to talk to me.
We can see it. We can see it.
Okay, cool. What screen do you see currently right now?
FDIC.
Okay, awesome. So we're not going to jump into that right now because Jay gets excited when I go straight there. So we're not going to do that right here. But I got to first bring to your attention why you as the consumer, why you don't know about insurance policies in the manner that we do. And it will bring a lot of things into context. And so to tell you the truth, sometimes truth hurts, but in truth, you can find facts. In facts, you can find money. And when you can be able to historically, statistically, and scientifically prove how what we do and what we teach is literally the best option for the common, average, ordinary person that's trying to be successful in life, it literally will help you be able to put yourself into a position to where you can actually put yourself in authority as a practitioner in this thing that we call insurance. And so the very first thing I want to do, I want to pull up something, and I want to pull up why we don't know about insurance and the way that we're teaching it today, to show you that these practices have been being done for a long, long, long time. We just didn't know. So what I'm going to go, I'm gonna start here. We're going to look at Jim Crow life insurance rates, but we're not going to get all into the meat of it. I'm going to pull something out that's contextual for everyone to be able to pull out and use. So there's a reason why we don't know about these policies and how they function, right? So in this paragraph, there's a couple of things that what we have to understand, whether you're white, black, Puerto Rican, or Asian. Of course, we know the history of America. However, what we also don't know is that low income white America, or low income people in general, were almost put into the same class as African Americans at one point in time, as far as when it came to like financial things. Okay, so I'm just going to read this real quick, and I'm going to point out some things that are the most important things. So it says, following the Civil War, race-based practices first emerged in a specialized form of life insurance marketed to low-income working people. So the type of insurance that was marketed to the average ordinary person, specifically black, the next are low-income working people. were marketed to low-income working people. It says beginning in 1870s, newly formed life insurance companies, American life insurance companies, including Prudential, MetLife, and John Hancock, known as the Big Three, sold small individual policies to a growing market of low-income wage earners. So the growing market of low-income wage earners were not only African Americans, but they were also Caucasian, white America, because there's a lot of white Americans that never owned slaves that were poor too. And so when it comes to that here, it says low income work. Watch this says. It says this type of life insurance called industrial or burial insurance provided protection against financial burden of a last illness and burial of the industrious class. So what this paragraph is just basically saying is that there's a specific type of life insurance that was only marketed to low income working people. That means that the reason why we don't know the wealth building practices and the wealth building strategies inside of life insurance policies is because if you were low income, or you were black, or you were Hispanic, you were somebody of color, or you were a Caucasian and you were broke and poor, you got sold the same type of insurance. It was low income insurance that was for only to protect you if you died. It was to only protect you if you died. We had no idea about the other portion of how life insurance worked for those that were wealthy. So when I go to that, first of all, we have to re-identify what insurance is, because we have to understand that when it comes to life insurance, the right screen is going to pop up here in a second if it stops messing up on me. Well, we have to understand that with life insurance, it's not called death insurance for a reason. The purpose of life insurance was to protect us for our entire life, not just death insurance. So a lot of times when we think about life insurance, the only thing that we think about is the death piece, and that's the only thing that we sell. And so I like to compare it to car insurance. If your car insurance company told you, family, if they said that you have to pay for the cost for total coverage car insurance, total coverage car insurance, but if you get in a fender bender, if your glass broke in your window of your car, if you got scratches, if the bumper fell off, we don't cover your car unless your car is totaled. But you're paying for total coverage car insurance. If you knew that you were paying for total cover car insurance, but the car insurance only worked if you totaled the car, would you think that that was a good deal, Jay?
Of course not.
Of course not, you wouldn't. You'd be like, wait a minute, why am I paying for total cover car insurance if it only covers me if my car gets totaled? So when we think about life insurance, we have to think about life insurance in the same context. If life insurance only covers me if I die, but I'm paying the cost of full coverage life insurance, that's not a good deal. I don't want life insurance only to cover me if I die. I want life insurance to cover me for the entirety of my life, which means bump, scrapes, bruises, and also a means to be able to protect my income and to be able to protect my money. So when we think about life insurance, what we have to understand is that it's just simply right here, that insurance is just a means. Insurance is just a means of protection from financial loss. So we want to put our money into something that protects us from financial loss. And when we think about it, there's a few people that you can pay attention to. That you have a couple of people or entities you can mimic. You can mimic the poor American. You can mimic the middle class. You can mimic the billionaire, or you can mimic the bank who funds the millionaire. So if you had a choice, poor class, middle class, billionaire, or bank that funds the billionaire, who would you want to mimic, Jay?
That bank, baby. I want to fund it all.
You want to fund it all. And so if you study Austrian economics, what you're going to realize is that Austrian economics, they believe in privatized banking systems, which means you control your banking function. The only time you go outside of your banking function is for larger purchases that your personal banking system cannot do. So if I were to want to amass large sums of wealth, I want to, by nature, I would want to mimic the systems and the industries that fund the billionaires that we admire. So when I was growing up, I never was a person who admired the person with the nicest car. I never was a person who admired the person with the most money. I never admired the person with the biggest house. I always wanted to figure out who was the entity that was funding these people's lifestyle, because I understood that that person who was able to fund that billionaire's lifestyle was probably a lot more wealthier than the billionaire with the limited amount of risk. So what we want to do, family, we want to understand, what do the banks do? Because if I can figure out what the banks do, by default, I can get what the banks have. I think y'all missed it. If I can mimic what the banks do, I can mimic and have what the banks have. And I want to have the same amount of money that banks have with the same amount of freedom that bankers have. So you look at that, you say, okay, what do the banks do? So what the reason why we're on the FDIC is because the Federal Deposit Insurance Corporation, they insure the money in the banking systems. So when it comes to the FDIC is government backed. Government is backed by the taxpayers, okay? So when you look at the FDIC, you can literally look up any banking institution to figure out exactly what they do with their money. What they do with their money, and based upon what they do with their money, it can allow for us to be able to see what the banks are actually doing with their money. So when we go to the FDIC, let me go back so that you guys can follow me. So you can take your clients through, or you can do it. You go to the FDIC.gov. Everybody write that down. That's a nugget. FDIC.gov. Then on the first page, you should see where it says Bank Find. Click Bank Find. When you click Bank Find, you're going to go down where it says Details and Financials. You're going to click Details and Financials. And then what we're going to do, where it says institution's name, we're going to put where it says institution's name. We're going to put that right here. So Jay, can you ask? You can see everyone's comments, right, Jay?
You know, I was hoping I could. I don't see any questions come in. If you can type in the chat or the questions, we do have the questions live.
Okay.
So if you have, if you want to throw a bank name out there, what have you. But right now, if you want to throw in, heck, let's Chase, Wells Fargo,
okay,
Bank of America.
So let's do Bank of America. So we're going to look up a bank because I want to see what the banks do. Because, you know, society tells us, Jay, they tell us to go borrow money from the bank. They tell us to put money in the stock market. That's what society is saying. But if the banks really believe that, they would do the same thing that they're telling us to do, right?
That's right.
So we're going to go to the Bank of America. So y'all don't think I pulled a fast one. You said where it says Bank of America National Association. We're going to click the one that says Charlotte, North Carolina, because this is the premier bank. They have over $1.8 trillion of total assets. As you guys can see, it says dollar figures and zeros, thousands. We're going to click the actual number 3,510, 3510. And as you guys can see, it says demographic information as of April what, Jay? What does that say?
A few days ago, April 30th, 2020.
April 30th. So this is the most recent that we can find, clearly, right?
That's it.
So we're going to look up the latest report day that we can. As we can see, the most latest report day is December 31st, 2019, to be able to look up the assets and liabilities ledger of Bank of America. So when we look up Bank of America, we're going to realize that it says Bank of America FDIC certificate 3510. Jake, what does this have to do with insurance? Family, it has everything to do with it, because when you see what Bank of America is doing with their money, it's going to have you question what we are doing with our money, therefore putting you in a position as the insurance agent to be able to accumulate and be able to help people amass a large amount of wealth and also accumulate wealth for yourself. So this right here, it says dollar figures and what, Jay?
In thousands.
So that means that any number that we see, we have to add 3 zeros to the back of the number. Okay, Jay?
Got it.
Okay, so look. So this is bank premises and fixed assets along with real estate. So it says here that the banks have 18.7, add 3 zeros, $billion of their money in real estate. You see where it says this right here, Jay? Are
Yes.
we looking at the same thing?
Yes.
I added the 342,000 plus the 342 million because we have to add 3 zeros plus the 18.4 billion dollars. I added those together. That'll bring us to 18.8 billion dollars. You see this?
Yes.
Okay. So let's see. They have 18.8 billion dollars in insurance. Now there's a going thing that says that we're supposed to have our money in real estate, right, Jay?
You hear it all the time.
We'll see if the banks believe that what they're telling us. So they have $18.8 billion in real estate. But when we go to line 41, life insurance, does it say liability or assets, Jay?
Life insurance is an asset.
So they say life insurance asset. How much money do they have in life insurance?
Well, if you add the 3 zeros to that, that would be over 22 billion.
So they have $22 billion in life insurance cash value reserves, and which is like what, $4 billion more money in life insurance cash reserves than they do in real estate.
That's what it's showing.
So I'm not a genius, Jay, but something's fishy here. Something's
obvious. Yeah, it's obvious what to do with the money, right?
It's very obvious what to do with our money. Now they're going to ask Jay, they're going to say, Jake, what does this have to do with insurance? Everything. They have more money in life insurance cash reserves than they actually have in real estate. They have more money in life insurance cash reserves than they have in real estate. Now let's scroll up real quick because we have to look at where it says total bank equity capital, because this is the money that they have in stocks and things of that nature. So let's see where the banks are putting their money when it comes to stocks and equities. When we look at this, Jay, let me move this over here so I can see it. When we look at this, Jay, hold on, let me go back. When we look at securities, because securities are what stocks are, securities. When we go to line 5 securities, we're going to realize that they have $444 billion in securities. So everybody says, oh, well, we're supposed to put our money in stocks. Isn't that what they tell us, Jay?
That's what you hear.
But if I want to mimic the most illustrious, sexiest, wealthiest industry in the world, I need to mimic the banks. So the banks have more money in insurance reserves than they have in real estate. And when it comes to securities, oh my gosh, they're not buying billions of dollars of stocks of the Fortune 500. They're buying securities from the U.S. government bonds, backed by mortgage, backed by bonds. Well, Jay, if you look at the asset class of insurance reserves, 70 to 78% of all insurance companies have the majority of their money invested in what?
There you go, right there. Government,
bonds, right?
Yeah, the bonds.
So wait a minute, Jake. Wait. So why are we getting information to invest in the stock market? Why are they giving us information to invest in real estate? Well, first of all, we have to understand that the banking institution controls the Corporation of America. They run America. So of course they will want us to invest our money in stock markets because they make money per trade. The commercial banking system controls the stock market. They make money for every transaction. They make money for housing the money. Of course they want us to buy real estate because they've created a system to where about we feel like we need them to get into real estate. So if you look at the function of it, wait a minute. The banks are making money, lending money out, having us to believe that we have to borrow money from them. And then they're also taking all their extra cash and then they're storing their cash in insurance reserves. Well, it looks like to us, Jay, we've been trying to do the wealth game backwards. The average ordinary American has 70 to 80% of their wealth, of their money inside the stock market and 5% of their portfolios inside of insurance reserves. When we looked at the banking institution, they're doing it absolutely opposite. All of these things are possible. So the question must be, Jake, why on earth would the banks put all that money inside of life insurance? It just does not make sense, Jake. Why would they put $22.5 billion inside of life insurance? Well, let's see why. We're going to look up what is bank-owned life insurance inside of Google. What is bank-owned life insurance inside of Google? And we're going to go to the very first definition by Investopedia. And let's look up what is bank-owned life insurance. Bank-owned life insurance is a form of life insurance purchased by banks where the bank is the beneficiary and also the owner of the policy. That's very simple. They own the policy, they control the policy, but they take policies out on their employees. And they store their cash inside of the insurance reserves because the insurance reserves are used as a, what does that say, Jay?
Clearly tax shelter.
Oh my gosh. Now let's play Blue's Clues for a second, Jay. In order for something to be a shelter, it has to protect something from something, correct?
That's what a shelter is.
So I wonder what needs protection from taxes.
Wouldn't be money, would it?
Oh my gosh. Money. It's a tax shelter for the financial institutions, which leverages its, oh my, what's that say, Jay? Tax what?
Tax-free savings, not tax-favored, tax-free savings. Yeah.
Tax-free savings provisions as a funding mechanism for employee benefits. Oh my gosh. And if you do history research on Walmart, Walmart used to take out a key man insurance policy on every single employee that they hired. And they used to get a cash-focused key man insurance policy that we call a banking policy, so they can be able to dump as much money as they can inside these cash reserves on every single employee that they had. And at one point in time,
they were the owner.
Yeah, that's right. Walmart were the owners. And at one point in time, Jay, Walmart didn't even have to tell the employees that they were taking out policies on them. Now they have to be open and say, that we'll give, we're taking out a policy on you, and they sign it, but people don't look at their benefit packages. And so Walmart has literally been storing and stashing cash inside of all these cash reserves with the millions of employees that they have, using the cash reserves as a banking function other than going to the banking institution and borrowing money. They control their banking system. All of these things are important when it comes to you actually learning how to apply these banking strategies to your families, to families that we help, to their portfolio. And so when we think about it, Jay, if we go to Facebook right here, this is going to show on this, it says up this top corner up here, it says 3 years ago. Can you see that highlighted?
Yes, sir.
I've been teaching where it says personal banking with MIB 227. That's what we call more infinite banking. 227, that was like our secret code for how we talked about insurance banking. But I've been talking about this banking system. Well, how many years does it say, Jay?
It's been a while. It was 3 years ago. 3 years ago is what that says.
3 years. And let me tell you something, family. It has never been a better time in history of insurance to talk to people about building insurance reserves like a banking system that you guys are learning how to do. It's never been easier. It was so hard to teach people these strategies 3 years ago because the world wasn't crumbling. But because the market is crumbling and people are scared and people want to get out of debt, and they realize that their debt is eating up their cash flow, especially for entrepreneurs that have more debt than cash flow right now. They want to control their banking function. They want to control and buy back their debt. And there's never been a better time in American history to put these policies into place. Family, we literally have clients all across America in over 25 states. We never leave our office. We just, with one webcam, we have clients and customers paying $1,500 a month, $20,000 a year, $10,000 a year. We have one client that we're trying to put together a deal, $100,000 a year that they're putting into this insurance policy that's focused on the banking strategy using insurance reserves, and they're paying yearly, no question, because they want to buy back their debt, because they want to be their own banking system, because they see the value of using their insurance reserves as a banking system, as a banking function. Do you know how much more wealthier we would be? How much more wealthier we would be as Americans if we stopped utilizing the banks and started to become our own banking system? Let me show you. Let me show you something. Let's see where our money is going. This is where our money is going. The average person in America makes 1.5 million. At this bottom, you see where it says lifetime income, the bottom section. The average person in America makes $1.5 million over their lifetime, Jay. $1.5 million over the lifetime of their working career. This is with an average of $35,000 to $40,000 a year over a working career. They make $1.5 million. Out of the $1.5 million that we make on average, one at the top level, how much does that say goes to debt and interest, Jay?
Oh gosh, over $1 million.
So $1,082,577 of our $1.5 million goes to debt and interest paid to the bank. So it's not our investment strategies that are killing us. It's our dependency on a banking system where they're eating up all of our money because we're paying debt to them and interest to them. What if we could show our clients how they can become their own banking system? And what if that $1,082,577 can be in their family banking system other than going to Wells Fargo, Bank of America, Chase Bank, F&G, whatever your bank is? What if your family could assume the interest and the debts being paid to their insurance reserve into their banking system other than going to Chase, Wells Fargo, and Bank of America? How much more wealthier would we be? If you just if you never saved money for retirement, Jay, and you only use your insurance reserve to buy and finance cars, to buy and finance your homes, to buy and finance your vacations like we use credit cards. If you only used it for those purposes, you would have at retirement $1,082,577 at retirement without saving your money in the stock market. You can literally just do that with insurance. How many clients do you think would love to see this, Jay?
They need to be educated on it. Absolutely. So many need to understand how money works and what they can do with their dollars, how they can direct it, how they can make money work for them. It's important to be able to educate the client to a point to where they make that decision. And everything that you show allows agents, advisors, to do that. Absolutely. Everybody needs to understand, how to utilize cash value life insurance in this manner. Everybody.
And here's the deal, Jay. Let me tell you something. When everyone, I want you to write this down. This will be the key to your success in this industry. Write this down. Educated families make educated decisions 100% of the time. Educated families make educated decisions 100% of the time. There is no need for sales tactics, learning sales skills, if you can show your clients, not through emotions, not through manipulation, just with facts, research, and numbers, how this economically makes sense financially for them. And 100% of the time, you will close the clients if you're in the right market. And 60% of the time, they will pay annually. They will pay annually. They will take money out of let me go. They will take money out of savings account and literally dump it into the insurance reserve. No question. Because why? I'm about to bring up my screen. I'm going to take me off. I'm going to bring back up my screen. Here's why. Because if they put their money in a savings account, right? We're not comparing apples to apples with 401ks, families. Don't do that. Don't compare the cash reserve to stock products. Compare the cash reserve to the banking system, because we are trying to get families to become their own banking function. So we're not selling it as an investment product. You're selling it as a banking product. In IRS code 7702, 72E, 101A, TEMRA, TEFRA, and DEFRA, those are not reasons why we can do what we do. Those are limitations on why we do what we do. So if you're saying because of the IRS code 7702, 72E, 101A, TEMRA, TEFRA, and DEFRA, because of these IRS codes, we can do these things. That's not true. Those codes were put into place to put limitations on how much we can do what we do. IRS wasn't created until 1913s. Insurance companies been around before then. So the actual function of what we do are not because the tax codes allow it. They put limitations on it, like the MET guidelines, the target premium guidelines, the death benefit guidelines, the death benefit test, the cash value test. Those were all things to be able to slow down our ability to become our own banking system. Because before 1979, before 1984, when TEMRA, TEFRA, and DEFRA were put into play, people could literally get a $50,000 life insurance policy and put $5 million into their cash value reserve without hitting a MET guideline. When they begin to understand how they can become their own banking function. So let me ask you a question. If we were to do a side by side, Jay, in your savings account, you get 0.8% to 1.25%, or you can put your money in an insurance reserve that gives you guaranteed 4%. Where would you want to put your money?
And a guarantee.
Why is that?
It's predictable.
It's predictable, and it's 4% more that you will get on your money than you would in a savings account, correct?
Absolutely.
So when you tell your clients your savings account, the bank is borrowing money from you, making 6 to 28% on your money and only giving you 0.8%. Do you like that deal?
No. No.
But if you can put your money in a reserve where they give you guaranteed 4%, would you like that deal?
Absolutely.
What if I told you, Jay, that not only are you getting the 4%, but you're also getting 2 to 4% of dividends on the insurance company's ability to be profitable? Would you like that deal?
Absolutely.
So you get a guaranteed 4% plus 2 to 4% dividends on top of your 4%. Now, where would you want your money? The savings account or your insurance reserve?
I still want to keep it in the insurance reserve.
Okay, let me ask you a question, Jay. If you saved your money over 10 years, say you save $10,000 a year in a savings account, and you save $10,000 a year for 10 years, how much would you have in your savings account?
100,000.
If you died, what would your family get?
Well, 60 something after taxes.
After taxes and probate, correct?
Yep.
So you got $100,000 in your savings account. It's only getting 0.8 to 1%. When you die after taxes and probate, you may get $60 to $75,000. Or you can save that money inside of your insurance reserve. And if you put $100,000 in your insurance reserve, you can not only have access to about $97,000 of that money, but if you died, your family gets $500,000. Which one would you like?
Absolutely that one.
And why is that, Jay?
All of the benefits you just, my family's going to get money and more money when I die. I can use it, just everything that you just mentioned.
So which way makes more sense to you? To put my money in a savings account that doesn't give me any love, or to put my money in a place that gives me not only dividends, not only guaranteed 4%, not only allow me access to my money, but also grows tax-free and also get it tax deferred and also get it tax-free. And if I die, I get 4 to 5 times more money than I actually put in. That's a win-win to me, if you ask me, right, Jay?
It's all about educating the clients to understanding the best decision that they can possibly make for their family. Like you said when you started, that's what it's about. Absolutely.
So did I have to sell you on that, Jay, for you to see that?
No, you had to show me. You had to educate me.
All I had to do is educate you. All I had to do was show them just the guaranteed side. See, Jay, I sell policies, this banking system, Jay, only using guaranteed numbers. Only using guaranteed. On the guaranteed side, year 10, you put $240,000 into this plan. You see that, Jay?
Yes.
Now, at the bank, if I put $240,000 into my savings account, I would have access to $240,000, correct?
Yes.
If I died, my family gets $240,000 minus taxes, minus probate, correct?
Yes.
So now, but in insurance, you put $240,000 in, you have access to 210, but if you die, your family gets what?
1.7 million.
Now, I'm not no scientist, and I'm not a mathematician, but that clearly makes sense. Now, if I go 10 more years down, Jay, I'm only using guaranteed. If I save $24,000 a year in the savings account, and I got $480,000 in my bank savings account, I would have access to $480,000 in a traditional bank. But if you use an insurance reserve bank, you put $480,000 in, you're guaranteed to have what in 20 years?
$530,000 in 20 years.
And if you died, your family get what?
That 2.2, it grew.
If I add the dividends as icing on the cake on the right side, that's $96,000 of dividends added on top of my guaranteed 4%. And then I go all the way down to the bottom, Jay. And I say, you put $720,000 into this insurance reserve, and you're guaranteed to have what in 30 years?
$968,000.
And then when you die, your family gets what?
2.5.
Now, if I were to ask you, Jay, would you rather save your money in a savings account, or would you rather save your money in the insurance reserve? What would you say?
Well, considering I have access to my money in either place it is, I would rather save it in the reserve.
So my next question to you, Jay, is how much money do you have in your savings account? He would say, I have $24,000. Well, now that you see the value of putting $24,000 in the savings account versus the insurance reserve, how soon can we be able to move forward to be able to get your money to do exactly what you just seen doing right here? ASAP. What do I got to do? Easy. Just like that. It works just that simple. If you understand the value of being able to educate families versus selling them, and then you just show them the guaranteed side. And then when they see the non-guaranteed side, which are the dividend side, it blows their mind. When you can show them how they can become a cash asset millionaire, a liquid cash asset millionaire without ever having to be an entrepreneur, just by saving $24,000 a year that they can use and have access to immediately. And you get access to your money within 31 days. You can begin leveraging your money within 31 days. And we'll talk about more about that on another Wednesday when I can break it down even more. But other than that, Jay, I've exceeded my time. Back to you.
Well, rightfully so. Hey, Jake, thank you so much for the insight, the way you present, the way you show, help educate your clients, because that's important. When you have the confidence and ability, when you know that you can show your clients a better option, a better solution, and showing, advisors and our partnered agents, these little techniques, these little tools, as you absorb this and you take this and you put it into practice, all you're doing when you simply go sit down with your client is you're helping them make a better decision on where their money can go. If you lay out all the plans, kind of like you had illustrated there, if your client has the option to put their money in things that they've already been taught, 401ks, mutual funds, 403bs, IRAs, savings, CDs, whatever the case may be. Now, the disadvantages to these things are, the taxation, the limitations on how much you can put in some of them. The money's not liquid, right? You don't have any guarantees. As a matter of fact, your money's at risk. It's not safe, right? But when you're educating your clients and you're talking about these options, you're showing them things, you're showing them, where banks put their money, very, very valuable information. They have that confidence of knowing, okay, this is a good, solid decision. Well, wait a minute. If all these things, all these places that I can put my money, savings, CDs, mutual funds, 403s, 401s, whatever, have all these disadvantages, but yet over here, I have an account that is liquid. It is guaranteed. It is safe. It is tax favored, tax free in certain situations. So again, it avoids probate. It helps with planning. And then everything that we do as agents, all the tools that we have access to, you heard Dane talk about the IUL selling system. That's phenomenal in how you can simply reach out to the client and illustrate these cash value, how lifetime income side by side with their 401k or whatever plan that they, vehicle that they use for retirement. It's phenomenal how you can show them. It's phenomenal how, we have plans in place where we can show people how to sit down, eliminate debt immediately, protect and cover all of life changes, and take that debt, get rid of it debt free for life, have the ability to make big purchases later in the future. We have the ability to show people, we're putting together plans for our clients and that where they've been living on a certain amount of income for their entire life, right? And up until whatever age that we put the plan together for them to retire, now they're able to live on 100% of the income, up to 150% of the income they're currently living on. They can start taking their draws at retirement, taking income. And this is all from simply repositioning a few things, and redirecting money, making their money work for them better, keeping the interest instead of giving that to the banks as discussed. The way Jake described how the banking system's set up to eat up our money everywhere we make a purchase, right? Well, what if you kept that money and you gained earning power on those dollars, and now those dollars are working for you. You're using your money twice. You have the tax advantages on that. So again, you're earning power on the tax dollars not going out. You have earning power on the interest dollars not going out. You have earning power on money that's still growing cash value in your account while you're taking care of debts. There's so many strategies and ways to reposition that work so well for people. It's just a matter of sitting down, absorbing the training and the knowledge, contact us. Let's work together, utilize one of the systems, go to the boot camps, whatever, is available. Utilize these tools that you can sit down, plan with your client how to eliminate their debt, plan with your client how to have a guaranteed lifetime income, and just simply redirecting what they're doing with their money, not doing anything different. And if a client is educated enough and they have the confidence to know that this is the best decision and they're making that decision, they don't feel like they're being sold on this decision. It's a world of difference. The client's excited, like Jake said, they're ready to get up and move. They're ready to take that money and put it into an account that's going to work for them. And all of these things that we do, it's very important. It's amazing when you can take a family and show them what they're currently doing side by side in a plan and say, hey, just by simply doing these few things that we recommend, now all of a sudden, now you have, instead of just over $1 million of retirement, now you have $4 million in retirement. You have a little more than that to leave to your family if you pass away. You have income for the rest of your life. You have income that's equal to or greater than what you were currently living on. Your house is paid for. You're debt free. And these are not blown out of proportion scenarios. These are strategies that have been executed, currently being executed, and will continue to be executed, due to life, cash value life insurance policies, repositioning assets, doing certain things with cash flow that's not changing their lifestyle. As a matter of fact, it's increasing their lifestyle. It's increasing their net worth. And we're excited to do that. We're excited to, have people like Jake who are out there. He's helping thousands of families execute these plans. When he sits down and talks about these little bits and pieces of education points for his clients, these are things that he uses when he's directing his clients to a phenomenal plan. plan that he talks about, walking them through the illustration. You know, we have things that you can utilize to make it so much easier to give the message to the client, you know, like the IUL selling system, the banking system, all of these things that we have, you know, that are available, you know, and so, you know, make sure that you're utilizing the tools, you know, attend the boot camps as they come up. There's going to be a boot camp, a release date about, you know, banking through insurance, life planning with these clients, Life Plan 360, and taking these clients through a plan that eliminates debt, puts them in position to do all of the things that I say, leave probate and estate free inheritance to their heirs while they, you know, have an income they cannot outlive. And your clients will love you, thank you, and send you more people to help. And it's a great feeling to be in a position to educate your clients to make the best decision for their life. So with that, we have gone over a little bit, but you know, we feel like we have great information to share. We're helping the industry. We're helping advisors direct their clients to a better plan for a better future for everybody. And with that, as a byproduct, we're well taken care of from the carriers. So I want to thank everyone for being on.
Jay,
yes.
One more thing. I just want to, I need to say this is very important. When it comes to us explaining this banking system using insurance, please don't be out winging it. Don't over exaggerate. Do not lie. If you do not understand the tax codes, call ICANN. They can get you in touch with me. They can get you in touch with the people that you need to make sure that you're explaining it correctly. Because we have to make sure that we protect ICANN. We have to make sure that we protect your name. We have to make sure that we're protecting the systems that we are using. And we do not want to over exaggerate and not explain certain tax codes, certain laws, and certain structures correctly. And we have to make sure that we're doing that so that we're in compliance and we're not leading our customers and clients astray. And I'm telling you, the truth is good enough. So please, please, please make sure that if you're going to use the information that Jason's giving you, that Ray's giving you, that BJ, that our Life Plan 360 will be given, please make sure that if you're uncertain or there's a gray area in your explanation, please just pause, get clarity first, tell your client that you'll get back to them, and then we can help you find the very best answer to be able to relay to your client. And I just wanted to say that, Jay. I'm sorry.
No, that's great. And what's great about, you know, the training, the boot camps, the software, the ICANN IUL selling system, it has compliance things, points in there, you know, to protect that. And you're absolutely right. By, you know, going to boot camp, getting the proper training and education, you're going to be able to lead your clients, you know, with confidence and compliant. And at the same time, you know, they're going to be making the best decision that they could have ever made. So, you know, thank you for your great words of wisdom, your nuggets that you share. And, you know, we look forward to having everyone on next week and also this Friday for our final expense training. So with that, I want to thank everyone for being on. This is Jason Martinez on behalf of the ICANN Financial family signing off.